Hi, this is Nick here for Merk Research, and right now I want to go through part of my chart book on the U.S. business cycle. But before I dive into the charts that are specific to the business cycle, I want to talk a little bit about why I think it's important to look at the business cycle and what the practical investment application is of looking at it. So this chart here will put things into a little bit of context. This is a chart going back to the early 1960s. The black line there in the top panel is the S&P 500 index in log scale with U.S. recessions in the blue bands. The lower panel there is what's called an underwater chart, and it measures the cumulative percentage drawdown from the previous all-time high of the S&P 500. And what this chart basically shows is that the big bear markets in terms of depth and duration tend to coincide with U.S. recessions. And so the takeaway there is that understanding the turning points in the business cycle is helpful and relevant from an asset allocation standpoint. For example, thinking about the timing of when to reduce equity exposure in favor of U.S. Treasuries or cash. So in large part, the question about timing equity cycles, bull markets and bear markets, relies on an understanding of the timing of business cycle expansions and contractions. Now, it's clearly not one-to-one, and I want to be clear that I'm not saying it's impossible for a bear market to occur without a recession. That's not the case, but historically, the balance of probabilities does seem to suggest that the bigger bear markets coincide with business cycle recessions. So I'll focus on the S&P specifically in another presentation when I go through that chart book, so I don't want to spend too much time on that now. Here, just trying to establish the market relevance of looking at the business cycle. All right, now moving on to charts that are specific to the business cycle. Now that we've established the relevance, let me jump in here with this first chart. And I guess even before I go into the details of this particular chart, I want to say that I refer to this section as the business cycle, but the goal really is to help identify the turning point in the business cycle. So it's not so much about where we are in the business cycle. It's really a question of, is the business cycle expanding, or is there a risk that it's about to turn over? I think it's very difficult to predict how long an expansion will last. This current expansion seems to have gone on for longer than I think many would have initially expected. So my only objective really with these charts on the business cycle is to determine whether it's likely that a turn in the business cycle is imminent. And by that I mean likely to occur within the next 6 months or so. So it's really, as I go through these charts, does it seem like the balance of probabilities, cross-referencing all these different data points, suggests that there will be a recession in the coming months, or it's most likely that the cycle will continue. Now, ideally, I want to be able to identify with about a 6 to 18 month advanced warning a turning in the business cycle, and that 6 to 18 month forward-looking time frame is what I think is relevant for markets. I was listening to a podcast the other day, and the guest had a funny anecdote that I think is generally true. He said if you told somebody that the S&P 500 annualized returns over the next 10 years were going to be zero, but the next 2 years were going to be fantastic, they'd say, great, I'll stay long stocks and sell them in 2 years. And I think that's just human nature and the nature of markets. And it reminds me of a thought experiment called the 2/3 game. If you're not aware of it, it's worth Googling. I think it's a great way of conceptualizing how financial markets work in the real world. But the main point there is that you want to be, at least in my view, you want to be one step ahead of the crowd, not 10 steps ahead of the crowd. And that's why this analysis emphasizes understanding these turning points with a slight lead in terms of timing, and why I focus on data points in this chart set that I view as being leading indicators. So to reiterate, when I go through these charts, I'm trying to answer the question, is the U.S. economy likely to fall into a recession in the next 6 months? And let me actually start by providing my conclusion from these slides that we'll go through, which is that for the time being, and I stress that this is only for the time being, it looks like there is an all clear signal. Chances are no recession starts in the next 6 months. If I were held to put a probability on it, I'd say it's roughly a 5% chance that the economy rolls over into a recession in that 6-month forward-looking time window. So what I want to do now is go through the slides with that lengthy introduction and explain what they are, what my framework is for looking at them, and given that I've already told you my conclusion, which is for now that I see an all clear signal, I want to explain what would get me negative on each of these charts. So let me start here with the chart that's up on the screen, which I think is a good overview chart. Now this has the same time frame as the S&P chart that we just looked at before. It has the same recession bands there in blue. This index is the Conference Board's leading economic indicators index, and it's the year-over-year rate of change in that index. So it's measuring whether that index has been rising and to what degree over the past year. So what this means, the 5.2, means that between, and this is a monthly data series, so between October 2017 and October 2016, the index rose 5.2%. Now you can see that historically, looking at these 7 recessions that are in this time window, this leading economic indicators rate of change year over year has fallen negative ahead of each of these recessions, and so it has acted as advertised as a leading indicator. There were 2 head fakes where it dipped negative and a recession did not follow, so that was in the mid to late 60s and the mid 1990s. Of course, it is possible for a recession to start without this indicator going negative, and I want to be careful not to read too much into any one of these indicators. The idea of going through these charts and this analysis is that I'm trying to work on getting a sense for the probabilities and basically trying to work the probabilities into our favor with the ultimate objective of making smarter investment decisions. So right now, just to say where we are, we're in positive territory, and actually well into positive territory on this year-over-year rate of change. The index has been accelerating higher. So that suggests to me that the expansion will continue until further notice. What would get me negative on this chart clearly is to see this year-over-year rate of change go to 0 or negative. Now, part of the reason of going through different charts is to cross-reference things. So this is one data point. If all the other charts were pointing to pointing negative, in other words, suggesting that the economy might be about to roll over, and this we're hovering in slightly positive territory, then of course, there's some subjective wiggle room on interpreting this. But for the time being, this chart looks very strong. To reiterate what would get me negative on it, it's seeing this year-over-year rate of change go negative. All right, let's move on to the second chart here. So the timeline is the same as the previous 2 charts going back to 1963. I want to define the yield curve steepness. Many of you are probably familiar with that concept, but here, well, in general, it's a long-term rate minus a short-term rate, and that's typically a U.S. Treasury yield. So here we're looking at the U.S. Treasury 10-year yield minus the U.S. Treasury 3-year yield. That would be referred to as a 3s-10s yield curve. Oftentimes the media or writers will focus on the 2s-10s curve, so the 10-year minus the 2-year. In this case, We're focusing on the 10-year minus the 3-year. And basically, the idea here is that as the short-term rate moves higher, which is typically driven in large part by what the Federal Reserve is doing, where they're setting their policy rate, which is the federal funds rate, and their policy in setting that rate is really oriented around hitting their inflation target, which is a 2% inflation target on the PCE year over year. Although the Fed does have a dual mandate, which includes inflation targeting and targeting full employment. With the unemployment rate at 4.1%, most would consider the U.S. economy to be at or near full employment. And so for the most part, I think the Fed is really focused on the inflation half of that dual mandate. Now, to talk a little bit about why this is relevant, I want to walk you through the basic concept of the banking business model. I think this is the way it was that I kind of envision it. It was written in a book, I think a very old book, that talks about the 3-6-3 rule, which is that bankers borrow at 3%, lend at 6%, and are on the golf course by 3 p.m. And the idea is pretty simple. On the liability side of the bank balance sheet, you want to be borrowing at a lower rate than what you're lending at on the asset side of your balance sheet. And that can be achieved in a number of different ways, but one of the ways that it's achieved is through borrowing at shorter term interest rates. Obviously, if you're a bank that is accepting checking account deposits of various customers, those typically have a very low interest rate, and then you'd go ahead and lend out long term, for example, lending to somebody buying a house in the form of a mortgage, typically a 30-year mortgage. So you've got a low short-term rate that you're borrowing at and a higher long-term rate that you're lending at. And the yield curve that we're looking at here basically captures that. And that's referred to as the bank's net interest margin. If the net interest margin is positive, that's encouraging of credit creation, it's encouraging of economic growth. When this yield curve steepness goes negative or inverted, that is suggestive that credit creation may start to slow down or contract. Now, this is thought to be a good predictor of recessions, and as you can see, the yield curve goes flat or inverted prior to each of these 7 recessions. I actually think that there's something more proactive about this other than being a good predictor of recessions. I think it has a direct cause of recessions, and it's through that channel of credit creation that I just walked through with the example of the bank's business model. Now, that's not true, or that is true not only of banks, but of other types of leveraged investors in general. So to go through basically the numbers, and I was able to find a yield curve chart going back a little bit further than this, back to 1954 from the St. Louis Federal Reserve website. And basically, those 2 additional recessions that were captured in that window off to the left here were also preceded by an inversion of the 3s-10s yield curve. And in general, the length of time between the curve going inverted, take for example this late 80s inversion, the length of time between going inverting and the beginning of the recession is typically about 15 months. That's the mean, median, and mode. Looking at those 9 examples, there were 4 examples where there were false signals: 1965, 1967, 1971, and 1998. So historically what we've had is a situation where the yield curve has always gone inverted prior to recession, but there have been a number of times where it's gone inverted and that has not been followed by a recession, which just on the face of it would lead to the conclusion that yield curve inversion is necessary but not sufficient as a condition for a recession, and that there would be at least a 10-month lag before the business cycle rolls over. I forgot to mention that I said the average is 15 months. The least amount of time is 10 months. The most amount of time is 20 months in this historical analysis. Now, that's only looking at 9 cases, so this is not to say that we can't have a recession while the yield curve is still positive, but it does give us an indication of a base case scenario of what to expect. So this, as you can probably easily tell, this is 42 basis points or 0.42 percentage points of difference between the 10-year yield and the 3-year yield. And what I'm looking for to get me negative on this is for this to actually go inverted. My base case scenario is that we will have yield curve inversion prior to the next recession, and that will be an advanced warning sign. So right now, it has been getting a lot of attention in the financial media that it's been flattening, and that's clearly true. You can see that trend has been going for years, and it's at the flattest level going back to 2008. That's also true. My framework is that as long as it's positive, the path of least resistance is continued expansion in the economy. We could start to see some warning signs once that goes to a flat level, which would be 0.00 on this chart, or inverted. All right, let's move on to the next chart here. This is U.S. PMIs. These come from the Institute for Supply Management. They're the Purchasing Managers Index. Without going into too much detail about these indexes, just from a high level, what I think is important to know is that the 50 level is the dividing line between expansion and contraction. There are two series here. The black line is the manufacturing PMI. The gray line is the non-manufacturing, or sometimes referred to as the services PMI. And with respect to the manufacturing PMI, that's thought to be probably the more important of the two and somewhat of a leading indicator as to what's going to happen with the services PMI and with the economy overall. So you can see that in the early 2000s, the manufacturing PMI led the way lower, followed by the services PMI. Similarly, in the 2000s, the manufacturing PMI led the way lower. It actually did dip into contractionary territory in late 2015, early 2016. I think the U.S. economy came extremely close to going into a recession right around that time period. It's recovered and reaccelerated higher, so it'll have to be something else that eventually tips this economy over into recession. So, positive picture here as far as I'm concerned. We've got both the services and the manufacturing PMIs well into positive territory in the high 50s. This is pretty much at or near the highs for this expansion, which started in 2009, and at or near the highs going back to the mid-90s. What would get me negative on this chart is seeing the manufacturing PMIs go below 50. All right, let's move on to the next chart here. This is from the New York Fed quarterly report on household debt and credit. The timeline here is going back to the early 2000s. It captures the last cycle, the last recession. The two lines are moving averages of an index that tracks the percent of total household debt that is current, which means debt that is not in any form of delinquency. So higher is better on those lines. This y-axis here on the right, as I said, measures the percentage of debt, household debt that's current or not in delinquent status. As households struggle to pay off debt, that line will decline as more and more debt moves into delinquent status. The deterioration in this index was an early warning indicator in 2006. We have two moving averages here, a faster moving, three-quarter moving average, that's the gray line. That sharply broke below the slower moving average, that's the six-quarter moving average, which is the black line. So that represented the point at which household credit really started to deteriorate, and that was in the second half of 2006, which provided an advanced warning on issues that wouldn't really crop up until 2007. And in fact, the S&P 500, which is represented by these gray bars here, peaked in October of 2007. So that was an early warning indicator on the business cycle and on the equity cycle. I don't know if that's going to happen this time around, but where we are now is certainly something that we're monitoring closely. You can see that these moving averages are really right on top of each other. Right now, the three-quarter moving average is at 95.18, just a hair above the six-quarter moving average at 95.17. This is a quarterly data series, so we won't get an updated data point until mid-February, and that'll be the Q4 number. And so we'll see what happens there. As you can see, back in 2004, these lines came very close to touching and then re-accelerated higher. We very well may see that again this time. Let's wait and see how the data comes out. There's no benefit, in my opinion, to trying to prejudge what's happening here. The idea is that these are leading indicators and to just follow the data as it comes in. One of the reasons, and so let me say I have no idea whether this will be a good early warning indicator in this cycle. The last cycle was so specific to household debt problems, specifically in the mortgage market. And, households have deleveraged a lot since 2008, both looking at it from a household debt to GDP ratio and a household debt service ratio. Both of those have come down considerably since 2008. So my framework for this chart is, if there is a clear deterioration in this chart, in other words, a sharp break lower of this gray line through the black line, something similar to what was seen here in 2006, that would certainly get me cautious, but I wouldn't say that we have to have a deterioration here as a necessary element to getting more cautious or negative on the business cycle. Part of the reason that I think that I'm hesitant to read too much into this chart is we really only have one cycle to go on. Unfortunately, this survey started in 2003. There's no data prior to that, so it's not as compelling as the yield curve chart, for example, where you've got many cycles to look at. All right, let me move on here to the Atlanta Fed GDP Now indicator. So this is kind of zooming in on the time frame. We're looking at the past few years. So this is within this, the time frame here is all within this current expansion. And it's a chart showing the Atlanta Fed's GDP Now indicator in gray versus the official Bureau of Economic Analysis GDP readings in black. So that, just as a note, you can say this says BEA, real GDP, QOQ, SAAR. Lots of acronyms there, but basically that means that this is the Bureau of Economic Analysis. Real GDP, meaning net of inflation, quarter-over-quarter rate of change, seasonally adjusted annualized rate. So that's looking at the latest data point would be the Q3 versus Q2. That rate of change, annualize it, seasonally adjust it, and that's the number that you get, which is currently 3.3%. That's the second of three readings. There will be a final reading, a third final official reading for Q3 GDP. The gray line here is meant to be a real-time estimate of where the current quarter's GDP will come in. So right now that's suggesting that the fourth quarter will come in at 3.2%. That gets updated as new economic data comes out throughout the quarter. So that changes a little bit. As you can see, it jumps around. But the idea is that it looks like growth is going to come in around 3% again for the fourth quarter, which would suggest that we've had about 3 quarters in a row now of 3% growth. So this chart's not necessarily a great leading indicator. It's just, the main takeaway here is that it looks like GDP growth looks stable around 3% for the time being. And in the context of discussing the business cycle, GDP growth is certainly a factor in that. So trying to understand a little bit about where we are is really the main purpose of this chart. As I said, it's not a great forward-looking indicator. So I'll leave it there on that one and move on to a labor market-related chart. This is the Conference Board Employment Trends Index. This is going back to the mid-1970s. As you can see, the labor market health, is an important factor in the business cycle. You can see this employment trends index deteriorating going into each of these recessions here. And so we'll look at a couple of indicators that I think are pretty good leading indicators with respect to the labor market. The first one is the JOLTS report job openings. So the JOLTS report stands for the Job Openings and Labor Turnover Survey. One of Janet Yellen's favorite reports. She's a noted labor economist and the current chair of the Federal Reserve. Her term as Fed chair will end in January, and she'll be replaced by Jerome Powell, who is not a PhD economist. He's a lawyer by training. But in any case, Yellen really liked this report, and I think it's a good report for tracking the health of the labor market and one of the forward-looking indicators for the labor market. So what this number is it's the, as it sounds, the job openings in the U.S. So 6.093 million job openings was the last reading. That was for September 2017. And similarly here to the household credit chart, I have a moving average analysis that shows a faster moving average in blue and a slower moving average in black. And the idea is that a crossover of that faster moving average below the slower moving average would be a negative. So that happened in the last cycle in about mid-2007. So right now we're at or near the highs for the expansion in terms of job openings, which suggests that the labor market's healthy, lots of availability of jobs. So there's nothing in this chart to be negative about in my view. What would get me negative is to see that blue line cross below the black line. Okay, and then similarly from the same report, this is the quits rate. That's exactly what it sounds like. It's the number of people that have quit their jobs in the month as a percent of the jobs out there. So that's 2.2% as of the last reading. And again, that's at the highs for the expansion. That suggests a healthy labor market. And the reason there is really that if lots of people are quitting their jobs, that's a sign that they're confident that they can get another job or get a better job, I guess, ideally. And so positive chart here. Again, what would get me negative is to see the faster moving average break below the slower moving average. All right, so in conclusion, we've looked at leading economic indicators. We looked at yield curve steepness. We looked at the PMIs. We looked at household credit conditions, GDP growth, and some labor market charts. All of these charts or concepts are somewhat interrelated, as is the economy in general. So the idea is that to have different data points to cross-reference, but of course many of these things are intertwined. As I said at the beginning, on balance, to me the data suggests that the expansion will continue over the next 6 months. That's kind of the time frame that I would assign to what I'm trying to figure out here. So that most likely the expansion continues over the next 6 months and in general until further notice. I've talked about what would get me negative on each of these charts. So going forward, I'll circle back and update the data and provide an update. Much of the data that we looked at is monthly, and so my plan will be to provide a monthly update going forward. I think that's about the right frequency to look at this data. It's not too beneficial to focus on every little tick. So hopefully we can come back and see where we are in the next month. Please send feedback to info@merkinvestments.com with any questions, suggestions, or comments. Our next presentation will be on the U.S. equity market. Let us know if you'd like to be informed about that, as well as the next installment on the U.S. business cycle, which we intend to put out in January. Other topics that we intend to cover under separate presentations include fixed income, real estate, commodities, currencies, and various special reports.